Alexa, cancel music. Hello, everyone. Welcome to another edition of Credit Conversations Q&A, where we're trying to help you with your money mindset and your credit consciousness. My name is Haile Rainey. If you're watching this for my webinar for the first time, welcome. If you've seen my previous videos, thank you for coming back. The purpose here is we talk about all things credit, and we try to keep things light, and we try to keep things fun. I try to deliver, I deliver information to you about all things credit. I try to pick topics that we talk about every week, and then allow folks to have Q&A on credit issues that are top of mind for them. So I want to thank you for this. This webinar is sponsored by Credit Renovators LLC.net. So what we do is we're here to educate you about all things credit, whether it be personal credit, business credit, corporate credit, business funding and lending, as well as business strategy and structure, so that we can help you set up your business so that you can maximize your ability to get funding for your business, and obviously get you funding in your personal life. So if you want to buy a house, you want to buy a car, you want to buy a business, to start a business, that's what we're here for, to help you with all of those things related to credit, related to finance, and related to funding. So first, I'm going to start off. I'm going to talk to you guys about avoiding the 5 biggest mistakes that home buyers make. All right, because right now the chat room is pretty quiet. Nobody's saying anything. So everybody out there, hopefully, I guess you're tuned in and waiting eagerly to listen to what I have to say. So I'm going to wait and give folks a chance to chime in later on in the Q&A section. So a lot of you folks out there, you're concerned about your credit because one of your main goals is to buy a home. You want to buy a home, or if you already own a home, you want to upgrade to a nicer home in a nicer area. And so in order for you to get the best, not only get qualified and get an approval, you want to be able to have the ability to have the best terms. That way you get the best interest rate, and especially right now where interest rates compared to the ultimate lows that we experienced a few years ago are higher than that. I mean, a lot of folks argue that rates are high. They're just high relative to what they were. Because I go back, the beard tells you, I go back to a time when interest rates were 13%. And so, yes, home prices were lower, but interest rates have been higher in the past. And so we go through the cycle. Of course, yeah, we would all love to see lower rates. So I'm sure for all of you out there on the fence and you're looking to buy, the best thing to do is make sure you're ready for that. So obviously purchasing a home is a major milestone. And many buyers unknowingly make those critical decisions, but they oftentimes make a mistake, because I found that sometimes people are eager to buy, but they're not set up for it. Because remember, there's a number of things in addition to credit that you want to have in order when you're buying a home to make your home buying experience good, and to make you put yourself in the best possible position to where you can have choices, you can have options, and have many options in terms of what you buy, where you buy, and buying it in a way that is affordable for you, which makes your purchase, after the purchase, there's the paying of the loan, to make that experience as sustainable as possible. Because I don't want to see you over your head in terms of buying more house than you can afford, or having to deal with unfavorable financing. Yes, there's always an option later if you take unfavorable financing to get you the house. Yes, there's always the opportunity for you to build your credit and then refinance later. But just remember, refinancing is still a cost. I know my loan officer buddies out there say, hey, don't downplay the refis. But just so you know, if you can get a lot of that at the beginning, that's great too. But nonetheless, again, refinancing is another option. That's something you can't do if your credit is not right, if your DTI is not right. So if you're looking to refinance, it's the same, it's very much the same challenge that you have if you're working on your credit and trying to buy. So again, these are the 5 biggest mistakes. And I'm mentioning them because I think these are the ones that have the most impact, yet they are the easiest ones to address up front. So when you guys see this, and those of you who will see this in the replay, feel free to comment below. And then what I'm going to do is I want you guys to comment and give me feedback. And then I'm going to share that feedback in a future webinar, and maybe even a future video that's not a webinar, but a future video for my YouTube channel. So please give me that input. If you guys that are in the profession, tell me, what do you want me to tell clients in terms of relevant items? My loan officer buddies, tell me, what do you want folks out there that are looking to buy, what do you want them to know in terms of lending? My realtor partners out there, what do you want people to know in terms of the housing stock? What's available? What's pricing look like? And I know that's different. It's regional. So I know there's folks out there all over the country, but I want your input because I want to be able to share that with the audience. And you guys tell me about that, and I will share that with them. So 20 plus years in the mortgage industry. And I can tell you, I love it every time. I love when people buy. I love as a loan officer, I loved helping folks get loans, both purchase loans and refis, because a lot of times they were doing the refi because they had financial goals, they had dreams and desires they wanted to do. So I loved with that. As a mortgage underwriter, I loved being in that decision-making process and helping people to get their loans. It was tough sometimes because sometimes you had to say no, but in most cases we had to provide conditions that they could, to help make the loan easier to approve. So sometimes some folks had challenges that we had to overcome to get them approved, but it's always a beautiful thing. Being in the credit space, I love when I'm helping folks achieve their goals and get their desires. When people say, hey, I effectively help them sell the house they were in, not as a realtor, but as an advisor, advise them how to sell the house they're in, move out of this neighborhood and move into another neighborhood, having their credit started out great, but we made it better. We went from good to excellent, so that she was able to buy in another area, a nicer area. She was able to buy more house, and she had better terms and she even had a better rate than she had on her previous loan when her credit was okay. But she didn't have a terrible rate, but she had even better rate on the new one going in. So she actually got more house in a better neighborhood, and her mortgage didn't change much from the old house to the new house. So that was that. And she had been in her other house 20 years. And so with the right set of credit circumstances and the right set of financial circumstances, we can often do that. We can make bold transitions to the next level without a heavier financial burden when everything is structured correctly. So getting to the 5 biggest mistakes that home buyers make. Mistake number 1 is applying for a home loan with unresolved credit issues. Now, make no mistake, not every issue on credit will stop you from getting a mortgage. Not every collection needs to be paid in order to get a mortgage approval. But what you have to worry about are large collections. And so what defines a large collection? that is a collection that is equal to 30% of the borrower's qualifying income. So if you make $10,000 a month and you got a $3,000 collection, underwriter's going to want you to address that collection. And then on top of that, if you got that collection and you have several other small ones, then you got to add them all up. And if they exceed that 30% of the adjusted qualifying income, then the underwriter is going to want those to be addressed with either show evidence that they were paid or get them paid or get them resolved, because there's a number of things, because they if you, in order for you to resolve them with a collection that large, if you end up making payments, now that may be a significant payment that has to be considered in your debt to income ratio. If it's not resolved, it's large enough, it may be a large enough debt for the creditor to go through the trouble. Once they find out you bought a house, they will go through the trouble of putting a lien on your house. If the debt, they're not going to do that with small debt, but with a large enough debt, they will want to put a lien on your house to force you to pay them and not allow you to ignore that collection. But yes, not all collections need to be done, but it's a lot better to resolve these things ahead of time than to do it while you're in the middle of trying to buy a house, trying to get a mortgage to buy a house. But here's the problem I see. Many borrowers do this assuming that their credit will improve over time. So they say, oh, I'll just start out now with what I got and see what I get. However, those credit issues rarely resolve themselves. You know, it usually takes some sort of effort, whether it's through dispute or digging or getting them validated and verified and find out it's not what the credit report says it is. It's really something less significant, and then getting it resolved, or even a pay to delete situation where we just decide, and it's in the best interest to pay off the debt, knowing that it's theirs, pay off the debt, get it removed from credit, improve the credit report, and thus therefore improving score. So not only will you not have a collection you have to deal with, you'll have a cleaner credit report that the underwriter gets to look at, and you'll have higher scores, which will help you not only in the pre-approval process, but in the termination rate, because the better your score, the higher your score, the better your report, the lower your rate's going to be, which is going to make your mortgage payment more affordable or lower. So why is that a mistake? If you got missed payments and they accumulate, they're going to kill your score. If you have no new positive credit in addition to having this negative credit, your score will stagnate or even start to decline. And when you do a loan application with these unresolved credit, the problems, depending on the underwriter and his or her disposition and the lender guidelines, you may get a straight up denial, and they'll say, come back when you get this together. And so then you end up with heartache, and then some people get disheartened. So I'd say you want to do a credit review first. You say, I'm thinking about buying a house, and you want to get your proverbial ducks in a row. That's one way to do it. You check the credit first, see what you know what your income look like, see what your debt to income ratio looks like. And then you got a few months to work on all these things and getting them lined up. So then when you pull the trigger, you got the best chance of getting a pre-approval. You got the best chance of getting a loan that'll be approved with a rate, a set of terms that you can live with. So how do you solve that? So if that's the case, so you say you want to you either work on your credit yourself through and use all the tools available to you, or hire a credit repair professional to address the negative accounts for you. Either option is acceptable. It all depends on what you want to do and how much time you feel like you have. Now, I personally have a AI-powered credit repair platform that will help you if you want to work on your credit yourself and save the money of paying somebody. It will do all the work for you. It uses AI to generate, you upload your credit report. It would identify all your negative items. It'll ask you what's going on with this from a list of pre-made selections. You select the situation that makes the most sense for that, and then you tell it what is your evidence. It'll generate a letter, and then you supply your documentation with it, and then you can print out the letters, and then you can go ahead and mail that off. Or if you want, there is an added service if you want to pay a company to print all your letters for you. You just upload the documentation in PDF, and you provide that to them. They will print that and print the letters that AI generates, and you send that off, and you can work on your credit that way. But either way, I recommend you work on it before you do application. If you find after reviewing your credit, you want to file disputes and take care of all the inaccuracies and the unverifiable stuff first. Those are the easiest things to get rid of, because if you can prove inaccuracies and they can verify things, those get removed fairly quickly. Then you want to set about, once you've done as much repair as possible, you do want to work on adding new positive history to help build your score. Things like secured cards, like that. But I recommend cleaning up all the negative stuff first. That way, when you go to start getting new credit, you can get better credit instead of some of the less than optimum builder cards with low limits and high rates, and they're not going to give you a lot of money, and having to put security deposits. If you clean up your credit a little bit more, you'll be able to build your credit. You'll be able to get new accounts that don't require deposits, that have higher limits, and that will have better interest rates. So, but it's up to you. But as a strategy, I would say clean up first, then build. And then you want to obviously monitor your credit, because you can't fix what you don't see. So you want to monitor your credit regularly. Annualcreditreport.com is available. You can look at it once a year. If you want to look at your credit report on a more regular basis, use one of the credit monitoring services. I know there's some free ones out there like Credit Karma, but just remember, if you use Credit Karma and you're getting 2 bureaus for free, most likely TransUnion, Equifax, you also want to, if necessary, pay for or go through another channel to get Experian, because you need to see all three. You need to monitor all three for problems on all three. Because keep in mind, in a mortgage situation, it's unlike other lending. In a mortgage situation, they're going to pull all three, because in the mortgage qualifying world, we pull all three scores, and then whichever score is the middle value, middle in terms of value, not middle of a column or something. But like, for instance, if you got a 650, a 620, and then a 635, the 635 is your middle score. And if you got multiple borrowers, we look at each borrower's 3 scores, and then we pick each borrower's middle score. And then out of all the borrowers on the loan, whoever has the lowest middle score, that is the qualifying score. So keep in mind that if you're going to be on a loan, you need to have your credit in good. If you're going to add a spouse or somebody else, a co-borrower, their credit need to be at least as good as, if not better than yours. Otherwise, theirs is going to be the one that gets used. You can never add a borrower to improve the credit situation. You can only add a borrower to improve the income situation. So that's that. So here's the problem. Okay, say you got multiple missed payments from 5 years ago. You might still get denied. I doubt it 5 years ago, because it's 24 months is most relevant. But it's a challenge if you haven't had any new credit since then. Now, if that particular account that had the 5 missed payments was the last 5 of the loan life, and you haven't done anything since, that's where the challenge is. But if it's an outdated account, you can dispute that away anyway. And then again, you should be building new credit. But it's always better to build on your existing credit once you've gotten rid of the negative stuff, any of your current stuff. So rather than, if you already got a credit card and say your credit limit is only $750 or $1,000, before you go out and say, let me go get another card, manage that account using low credit utilization, and then you can work on getting your credit limit increased rather than try to go out and get another low card. But that's important too. So you want to build, rather than go out and get new, build on what you already have first. And once you've built that out, then you add new stuff as needed, new accounts as needed, especially with credit cards. People often ask me, what's a good mix? I say 2 to 3 cards, but really it's however many you can manage effectively without problems. There is no limit there in terms of points or the algorithm or anything like that. Mistake number 2, paying off collections to try to improve your scores, right? So paying off collections might seem like a smart idea, but it doesn't always improve your credit score. The reason why is you have to pay off collections the right way. There's a correct way to do it, but just paying them off won't improve your score if the negative information related to the account is not updated properly. So why is this a mistake? Number 1, older score models like FICO 8, because 9 being the newest one, or Advantage 2.0, they still treat paid collections as a negative, because just paying the balance is not enough. You have to remove all the negative references to that account, because oftentimes when it's a collection, yes, it says payment status as collection and usually charge off along with collections. But remember, there are other line items on there that show negative too, like status. It may say derogatory. That's the negative data point. The payment status obviously says collections charge off. In the comments, it'll say collection. It'll say past due, borrower went default. And then even if you paid off that collection after that, they'll update it to say collections, client paid off after collections. Well, all that should have been removed when you negotiate a settlement. You would want to write a pay delete letter, submit it and approved and accepted in advance, saying that upon receipt of payment and whatever the negotiated amount, that this will be removed, so that once you pay that off, either the collection agency goes and contacts the bureau and says, update this. If it's a third-party collection, we want it removed completely from the credit report. If this was a original credit account that was in collection status, we would want them to update the account information to remove all those negative references. And that will help, because once you remove all of that, that will help your credit score. But just having a zero balance on it will not help your credit score. Also, if the lender happens to be using the new scoring model, which is FICO 9, it's going to automatically ignore any paid collections regardless of negative data points. But I always recommend that you clean up the file as much as possible, because even if the algorithm is not dinging you in points, when you got a live underwriter, which is always the situation with a mortgage application, it just looks better when they don't have to look at all of that. But again, if you need to clean it up for the score, to raise your score, you want to do it ahead of time. If not, you want to work on that. If your scores are good enough, you just want to clean that up for future reference. And you may not necessarily want to hold up on your mortgage application process if everything else is fine. But remember, the newer scoring models are not always widely adopted right away, because a lot of lenders are used to using the older model. They're okay with it. The new models sometimes cost more, so they stick with the other one at the price point that they're offering at. Usually only after they decommission, and when I say they, I mean FICO, when they decommission the older models and no longer make them available, usually then where lenders go ahead and adopt the newer model. So the solution for that is, number one, you want to dispute the collections, get rid of all the inaccuracies there, Or if it's small enough, I would say go ahead and negotiate the pay to delete agreement, where you would draft a letter saying upon receipt of payment and the amount of whatever you and the collection agency agree to, that this item was considered satisfied. And again, if it's third-party collection, it gets removed from the credit report. If it's an original creditor, we want all the negative references removed from the credit report. But depending on how your score lies and how big or small these collections are, you may not need to deal with them right now. If your score is sufficient for you to get an approval and the collections are small enough to where the underwriter doesn't consider them an issue, don't worry about them right now. You can fix that later, make your score better, save that money for your closing costs or your down payment, if at the end of the day, the collection either continues to report negatively or it's not enough to impact your loan decision. So you can't always wait. Now, if you need those points, if you need to remove those collections to help get your score up, then you may want to consider doing that, depending on the size of it. But I always say be wary of trying to add new credit to outdo negative credit. Adding new credit will give you a short-term temporary boost to your credit, but it is not a solution. You can't out negative. You can't use out positive the negative that's on there unless it's really, really old and really, really small to where it's no longer being a big impact. But anyway, basically, that's what you can do for that. So, example, even if the old collections drop off, your score won't improve that much because all the damage was done early in that collection. So, and then there's always a possibility if you check the statute of limitations for your state and the statute of limitations for the loan type. If you're close to the end, you don't want to pay it off either. You may as well wait. But you got to know where you are in the timeline for the debt statute of limitations for both the state and for the loan type. Mistake number 4, relying on a co-borrower for credit approval. And I mentioned this earlier. A co-borrower can never help meet income requirements for a mortgage, but both borrowers must meet the minimum credit score requirements, and the borrower with the lower score is going to be the representative score. So if you're going to bring somebody in to your transaction on a mortgage, their credit needs to be at least as good as, if not better than yours. So they can never come in and prop up your credit situation. They can come in and prop up your income situation, or they can bring assets to the transaction that might be needed for reserve requirements if necessary, or for closing costs. And that person says, if I'm going to give up money, I want skin in the game. So they may want to be on the loan and be in the transaction, maybe even be on title. So, but trying to rely on a co-borrower, you can't prop up the score. So basically, in a nutshell, if the required score for the program is 640, both borrowers need to have at least a 640 or above, or it's not going to matter. And even with excellent credit from one borrower, the low credit from the other borrower is going to bring you down because their score is going to be the representative score. And I know I'm kind of reiterating that, but I want to make it clear. It's different with mortgage than it is with, say, a car. Because like people try to compare when they need a co-borrower or a co-signer for an automobile purchase, and then they try to apply that same methodology or logic or rationale to mortgage. Mortgage is different. Mortgage doesn't look at one score. It looks at all three. It doesn't look at one bureau, it looks at all three. And the qualifying score is not the higher person, it's the lowest person. So keep that in mind. So the ultimate solution for that is fix your credit first. And if you need that co-borrower, if you need to co-borrow for another reason like income or assets, they need to fix their credit first, because if their credit is no good, it's no point in putting them on a loan unless you need their income. Because sometimes you have that situation, the person with the higher income has the lower credit. And if you need both incomes to qualify because of the purchase price area, then both of you need to fix your credit unless your credit is already great. But if you need to add that person for income, then their credit needs to be spot on, or at least, like I said, better than yours, or at least as good as yours. Because if this is better than yours, you're no better off, except you got the income you needed. So fix your credit first. And then secondly, if necessary, you may have to go private money, like a hard money loan. These tend to have higher interest rates, or maybe go lease option or rent to own to get into the property first. And then while you work on your credit, and then at some point you can go ahead and make that purchase and you'll already be in the property. Depending on the situation, you may end up being able to do, if you're doing a rent to own and you're paying towards your equity, towards your down payment, you might be able to do your loan, even though you're purchasing the property, you may be able to structure it as a refi, since that lease to own or land contract can be considered a purchase agreement, and you've already purchased the property short term, and now you're refinancing to get a new permanent lending. So it can be looked at that way. Mistake number 5. Ignoring the credit issues until you find a house. So a lot of people do that. They know their credit is not great, and they'll say, well, I'll fix my credit when I find the house I want. But the problem is you put a lot of pressure on yourself. Waiting until you find a home to address your credit and then address your credit issues can end up delaying the mortgage process. And sometimes you can aggravate the seller, you can aggravate the the loan officer, and you can aggravate the realtors involved, because you're taking what could be a 30 to 45 day process and you're dragging it out because you don't have all your proverbial ducks in a row. And so, again, it's all about preparation and being proactive. If you do that, you'll have a smooth process and you'll be like, man, this home buying stuff is not that bad at all. So why is it a mistake to wait? Obviously, credit repair takes time. At least 30 days to 6 months, depending on how much stuff you have to fix and how bad is it, and how bad overall, how many things need to be fixed to get you credit worthy. It takes time. It's a process. And so failing to address the credit issues until the last minute may even cause you a chance to lose the deal. Because if the seller backs out because you're taking too long to get your financing together, there's usually clauses in the purchase agreement that says you have so many days to get your financing in order, or you're in breach, and then they just cancel, especially if they have a property that is in high demand and they're getting a lot of offers. So even after they accepted your offer, they're still getting other offers. And you're not ready to swiftly move on it. They'll take the cancellation opportunity as soon as they can and then sell the property to somebody else. You'll still be able to go ahead and fix your credit, but now you'll be disheartened because you lost out on that opportunity, that perfect house that you found and got excited about. So what's the solution to that? First, start improving your credit as soon as you decide that you're thinking about buying. You want to consult with a credit repair professional or find you a good set of tools if you're going to fix your credit yourself. That way, either way, you come up with an improvement plan on fixing your credit in a certain amount of time. And in the meantime, while you're doing that, you have time to get your down payment and accumulate your closing cost funds and all of those things. Then you will set about working to build a healthy credit profile, giving yourself 3 to 6 months initially, and then maybe 6 to 12 months overall before applying for a loan. Doesn't mean you got to wait that long, but if you give yourself that much time and then you set to work doing it, you may find that you can get it done, get your updates much faster than that. So let me give you 3 guaranteed ways to get approved for a home loan. Number 1, improve your credit profile before applying. That's what we've been talking about for the last 25 minutes or so. You want to dispute the negative items and add positive accounts, but you want to make sure you're doing both. I prefer you get ahead and just get cracking on the negative stuff first, then start adding positive stuff, because it will help you. But just remember, as long as you got past due collection credit card accounts, it's going to be hard to get new credit cards account, because they're going to look at your credit and say, oh, you went belly up on the last credit cards account. We're going to not trust you. So we're either going to have a deposit, or we're going to say, we're not going to help you just yet. Come back later. So keep that in mind. And be prepared for higher interest rates, because if your credit score is not optimum, you may be able to get an approval. Because like a lot of people often quote that FHA will lend to you with a credit score as low as 580. But the problem is you typically can't get the 5.8. You can't get the 3.5% down with the 580 score. The lender may have an overlay that says you got to have at least a 620 to get the low down payment. Credit FHA may approve you at 580, but they'll require more money down. You may have to put 10% down, maybe even 20. And that can vary. But again, the lenders have overlays on top of that. So although FHA might go rock bottom, you won't have a lender that will lend at that, because the risk of default on the loan is too high, and they don't want to take a chance on you going belly up and creating a default record for them. So, and even if you did get the 580, you're probably going to have a really high score, which is going to make your loan payment really high, the loan part, which means that may reduce the amount of house you can buy. So you might not be able to buy the nicest house, or you might have to buy something a lot more modest to keep the payment reasonable because of the high interest rate. Tip number 2, you could consider using private money. I mentioned that earlier. That's the option we call hard money, but most of the hard money loans are designed for investment. Private money might be a private lender that will do residential lending, but they tend to charge very, very, very high interest rates, and because you're in a risky situation. So you could have a rate as low as 8% and as high as 13%. I talked about 13s back in the day with these private loans, because they price for risk. Now, the idea is there, if you secure a loan that way to get you into your house, you don't lose out on the house opportunity, and then you consider refinancing later with a more conventional loan when you've gotten your credit together and able to qualify for that. And then tip number 3 is you want to find a partner to help you, or consider a rent to own, lease to own, or land contract style agreements where you move into the property, you make monthly payments, and your monthly payment, usually a large portion of that monthly payment is rent, and then a smaller portion goes towards your down payment, and you may have a 12-month or 24-month option where you can make payments for 12 months, accumulate some down payment, and then if you're credit worthy, you go out and you try to get a mortgage, and then you can go ahead and buy the property. The seller has already has some of your down payment that you made over those 12 months. But then usually they have an option. If you're not ready, you can have an option to extend and go another 24 months, accumulate more down payment, have time to get your credit together. And so now in 24 months, you got more money down and you got better credit. And so you can end up with that. The only downside is usually the purchase price at 12 months goes up when they wait another 24 months, especially if you're in the area with a hot market. So keep in mind, you'll end up with a lower rate, but you might end up with a higher purchase price when you go 24 months versus 12 months when you're taking that extra time to get your credit together. So you have to kind of weigh out the situation to see what makes the most sense. But if you have a real flexible seller and they work with you, you usually can make it an agreement that works for everybody. They love it because they got a buyer locked in, because the option is yours to take. They're usually written that way. But this way, you can get into the property you want, you can secure it and improve your credit. And now you got a devil, and you're working on that. So those are the things. So if you avoid those things and do the opposite of those, usually that'll put you in a position where you can qualify for a mortgage. You can quickly get through the underwriting process, get to approval, and quickly close on your property with minimum fuss. If you got any condition, unusual issues, get them addressed or address them when you submit your file. Explain all of that stuff. Have letters in there to explain any extenuating items, just like you can explain any credit items, because they may ask those as well. So by avoiding these 5 mistakes, you can dramatically improve your chances of getting approved for a home loan. But the key is to address the credit issues proactively, add positive items proactively, and explore different loan options if the conventional options or the FHA options serve as a roadblock for you. If you follow these strategies, it will help you achieve your goal of home ownership while ensuring a smoother loan application process. So that's that in a nutshell. But I can tell you, if you do all of that, you will get in there. So I'm not seeing any questions in the chat, and I'm not sure if anyone has anything, but I would say if you end up watching this on the replay, feel free to put comments in there, or you can DM me if you have questions, or you can reach me through any of the links that you see in the description. So for those of you who are watching the replay, if you haven't signed up and registered to be on the webinar live, I encourage you to do that. I think these sessions go great when we have live questions, and that because the subjects can go any and everywhere on all topics, rather than allowing me to choose what I think is relevant to discuss. I'd rather talk about the questions that you guys get, because I get questions all the time on a single basis from folks. So I like to have them here, because usually if you have a question, that means at least one other person has the same question. So with that, I covered that. And again, I would recommend that you reach out if you're looking to fix your credit yourself. My platform, my AI-powered platform, is awesome. I'm still currently offering it for free for a limited time. I may do it through the end of this week, but I am offering that. It's a great platform if you want AI to help you fix your credit, help you create your letters, help you dispute your credit items. I recommend that you register, and I will give you access to that. And so, and that access can only come by email. And the only way I can email you if you register with me, and I will be more than happy to grant you access to the platform, and so that you can start fixing your credit for free. So until next week, I look forward to talking to you guys again. My name is Haile Rainey. Thank you for this credit conversation, and good luck in your home buying search. If you need resources on home buying, if you want lenders that you can pre-approve you, reach out to me. I can certainly refer you to some very qualified loan officers, some very qualified realtors. If you're looking to make that search if you don't have a house yet, I have realtors, friends of mine that I can point you to that will be more than happy to do that for you. So until next time, God bless, and you got to take care, family.